Imagine you have all your savings in one company's stock. What happens if that company faces a setback? You could lose a big chunk of your money. This is where diversification comes in. It's like having different baskets for your eggs. Diversification means not putting all your money in one place. Instead, you spread it across different investments. This way, if one investment doesn't do well, the others can cushion the blow. Think of it as a safety net for your money. Diversification is especially important in today's uncertain world. Markets go up and down, and it's impossible to predict the future. By diversifying, you're better prepared for whatever comes your way. Remember, don't put all your eggs in one basket. Mutual funds are a great way to diversify your investments. In simple terms, a mutual fund pools money from many investors and invests it in a variety of assets. These assets can include stocks, bonds, or a mix of both. Think of a mutual fund as a basket of different fruits. Each fruit represents a different investment. By buying into a mutual fund, you get a slice of all the fruits in the basket. This gives you instant diversification, even with a small amount of money. Mutual funds are managed by professional fund managers. These experts research and select the investments that go into the fund. They also monitor the fund's performance and make adjustments as needed. This takes the guesswork out of investing and makes it easier for you to grow your wealth over time. Equity funds are mutual funds that invest primarily in stocks. Stocks represent ownership in a company. When you buy a stock, you're essentially buying a small piece of that company. Equity funds offer the potential for high returns, but they also come with higher risk. This is because stock prices can fluctuate significantly in the short term. However, over the long term, stocks have historically outperformed other asset classes. Equity funds are suitable for investors with a long-term investment horizon and a higher risk tolerance. If you're saving for retirement, for example, equity funds can be a good option to grow your wealth over time. Debt funds are mutual funds that invest primarily in debt instruments, such as bonds. Bonds are essentially loans that you give to governments or corporations. In return, they pay you a fixed interest rate over a specific period. Debt funds are generally considered less risky than equity funds. This is because bond prices are less volatile than stock prices. However, debt funds also offer lower potential returns than equity funds. Debt funds are suitable for investors who are looking for a steady stream of income or who have a lower risk tolerance. They can be a good option for investors who are nearing retirement or who need to preserve their capital. Section 5. Hybrid funds, best of both worlds. Hybrid funds are mutual funds that invest in both equity and debt instruments. This provides investors with a balance of risk and return. The proportion of equity and debt in a hybrid fund can vary depending on the fund's investment objective. Some hybrid funds may have a higher allocation to equity, while others may have a higher allocation to debt. Hybrid funds are suitable for investors who are looking for a diversified portfolio with a moderate risk profile. They can be a good option for investors who are just starting to invest or who are looking for a one-stop solution for their investment needs. Section 6. Crafting your diversified portfolio. A recipe for success. Building a diversified mutual fund portfolio is like putting together a delicious meal. You need the right ingredients in the right proportions to create a balanced and flavorful dish. Start by determining your asset allocation. This refers to the percentage of your portfolio that you allocate to different asset classes, such as equity, debt, and gold. Your asset allocation should be based on your investment goals, time horizon, and risk tolerance. Once you have determined your asset allocation, you can start selecting specific mutual funds. Choose funds from different fund houses and categories to ensure diversification. It's also important to review your portfolio regularly and make adjustments as needed. Section 7. Tailoring your portfolio. Different goals, different strategies. Your investment goals play a crucial role in shaping your portfolio diversification strategy. Here are some examples. Retirement planning. If you're saving for retirement, you have a long time horizon. This allows you to take on more risk. Consider a portfolio with a higher allocation to equity funds, which have the potential for higher returns over the long term. Buying a home. If you're saving for a down payment on a home, you have a shorter time horizon. You need to preserve your capital and minimize risk. Consider a portfolio with a higher allocation to debt funds, which are less volatile than equity funds. Child's education. If you're saving for your child's education, you have a medium-term time horizon. You can afford to take on some risk, but you also need to protect your investment. Consider a balanced portfolio with a mix of equity and debt funds. Remember, there is no one-size-fits-all approach to portfolio diversification. The best approach for you will depend on your individual circumstances and financial goals. It's always a good idea to consult with a financial advisor to get personalized advice. Section 8. Conclusion. Diversification. Your key to financial peace of mind. Diversification is not about outsmarting the market or predicting the future. It's about managing risk and protecting your investments from the inevitable ups and downs of the market. By diversifying your mutual fund portfolio, you can reduce the impact of any single investment on your overall portfolio. This can lead to more consistent returns over time and give you peace of mind knowing that your investments are working hard for you. Remember, investing is a marathon, not a sprint. Start early, diversify your investments, and stay invested for the long haul. With patience and discipline, you can achieve your financial goals and secure your financial future.